that this might be a time, to make some kind of at least a short-term type trading. So from a short-term trading standpoint, we're going to, again, I like to use the average daily range if I can, but it's been, the average daily range has been all over the place. So, I had been using 20 points for the average daily range. If the market closed 20 points above the predicted high for the day, then you go long at that point. If then the market reverted back down, dropped down, you'd want to be out. If it, if you lost 10 points or if it was 10 points below the predicted low. And we'll explain that example a little bit more clearly in a minute here. If you are a trend follower and you want only to trade the longer term trends, you don't like so much, the back and forth and can't watch the market as carefully, you might want to use a 40-point criteria as far as when you want to enter. 40 points above the predicted high to buy, and then 20 points to exit if it drops 20 points from your entry point or 20 points below the predicted low. So let's just follow through on a couple of examples and kind of where it would have taken us if you were in that market. I said on October the 4th, we had a predicted high of 1115. Again, we don't know if this is a reverse to a trend or if it's just going to be more choppy and we can have to trade more of the swing trading or shorter term trading type of a strategy. But if we're using, we'll start out with the swing trade type of a technique, and we'll say that the predicted high at 1115 plus 20 points to get us on board would have us be a buyer at 1135, and that comes somewhere right in this vicinity right in here on the next day, 1135, where you would be long in the S&P 500 E-mini. And then if you were to think about building a trend and building a position, and you thought that, well, you could add on to it if the market continues going up, then at 1145, that'd be, or 1155 rather, which would be a 40-point gain above that predicted high that we're using as kind of our base for making a trading decision. 1155, you could add on to a contract. So one day you're in one position, the next day you're in two. Again, it depends upon the size of your account, how much risk you are willing to take. A lot of things enter in as to how you're going to trade this, but just as a general concept, as a general strategy, we're going to use a predicted high and the low to get in and get out. We had a couple of things that say as they started to come together, you could see that the predicted difference started to move to the upside. We had the Neuro Index move from 0 to 1, indicating a bullish outlook for a short-term period for 2 days ahead. So several things started to come together that would suggest that you would want to be long in this situation because something might develop after what was going on. Now, depends again here, how cautious are you? Are you more venturesome? Are you really trying to protect what you have? Well, let's say that you are playing the side of caution and you don't want to take a big risk. You don't want profits to evaporate. So when we got to this predicted low that we had here on October the 17th, we would like to get out of the market if it drops. That's the highest predicted low. We want to get out of the market if it drops 10 points below that. So that would have knocked you out at 1196. And it possibly would have knocked you out at even if your long position 1186. I think we just barely got to that point here on this candle on the next day. And so it would be a question, how, what is your feeling about, staying with the market, taking some risk? Obviously, if you are playing with the market's money as you were because you got long at a favorable spot, you might want to stick it out a little bit longer, put your stop a little lower. You might want to keep it like right at 1180, right below these lows. This is a combined technique with the traditional technical approach, but some way to establish a criteria as to when you will get out without taking the big risk, without seeing some of the money evaporate. But if you're venturesome, it's the market's money, you might want to expand that a little bit and just ride it out a little bit till we get up here to, of course, this big day on October 27th when we had the extreme. Again, if you were 10 points or 20 points, depending upon how you approach this market below the predicted low for your stop point, at that point you would be, out of the market, or you could still be in the market, or you could be out. But at October 27th, when the market made the extreme, I may put my line on the wrong one. This is October 27th, where it made that extreme move. You may want to pick a profit target and take it, depending upon whether you like gift horses, or if you feel that you want to hang in there. You're convinced the market's going higher. For the most part, based upon the news you heard, you might be inclined to have taken some of the money off the table at that point. And then when you had the doji candle the following day, again indicating uncertainty, some kind of a topping action, then you might want to look at that candle here that we had here, this October 31st candle with the predicted low on that day of 1260. Dropping 10 points from there, because that's where your protective stop would be, would have you out of the market at 1250 on that day. Now, of course, that's predicated on one thing. It depends on where you traded that particular day. If you happen to have an account at MF Global, as I do, it was frozen. There might not have been a lot you could do about it. You were caught in the turmoil, which is a very rare occurrence, but it was a situation that traders have to deal with, to be prepared for almost anything. It's kind of like, where you have lightning strike your trading system, or some other thing that happens, an unforeseen experience that occurs, and you need to find some kind of a backup plan in case that does happen. Anyway, to move on. Now, if you were in a situation here, you got out, then you could decide, well, there's our predicted low on that day. We said that predicted low was 1260. We want to be a trend follower. We could say 40 points below that at 1220 is where we would take a short position. Well, that would be right in this vicinity right here at 1220. Well, what happens? Doesn't take long before the market reacts to that, and it gets you stopped out very quickly right here. And if you keep your stop at 10 points, then you have a kind of a limited risk type situation. Didn't work out, but at least you kept the risk down to an amount that you could manage if you were faced with the worst of the situations. Now, on the situation here where we did have this November the 2nd, where the market did kind of come bouncing up, where we had the predicted high, that was at 1235. You would be a buyer at 1275, or that would be in the vicinity right in here, so it'd be nip and tuck as to whether you got in there. More than likely, if you're looking at it based upon how close these other highs are back here, you would say, well, let's put that stop above there before I want to go long. Before I think that the market is going to go higher, I want to have it prove itself. It has to go through those highs before it can go higher, so let's make it prove itself.